Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, May 13th, 2019. Let's go over the charts. We had a pretty big day in the market. Let's talk about what happened and what didn't happen. We'll start with what didn't happen. Basically anything remotely bullish today. So that gets that out of the way. Nothing but bearish check marks across the board. We'll get into those in a minute here. I'll just follow up with this chart. I shared this about a week or so ago. It's a chart that I've shared this one in the past. Years back, putting cycle lines 3 months apart to mark what I call, what's referred to as peak earnings season, where you have the majority of the market moving stocks, the biggest U.S. companies reporting, and and the thing about this too is keep in mind that this is a good example of why fundamentals don't always matter, and more often than not they're priced in. Fundamentals are, I always say, trying to trade. If you're a long-term investor and you've time horizon many years and you're very astute like a Warren Buffett, sure, use fundamental. That's what he does. Pick stocks that you're going to put away for 10 plus years. But when it comes to trading, trying to catch trends, fundamental analysis is akin to driving in the rearview mirror. By the time a company reports quarterly earnings, the quarter's already over. It's been over for almost a month at that point, and they're reporting information that's anywhere from a month to 3 months old. So, and almost always priced into the markets or into a stock. So what happened this time around was interesting. You had the majority of the market-leading FANG stocks beat. They beat earnings. They gapped up. They ran up. Apple, Microsoft, all these stocks, but yet those gaps have now been completely faded and then some. So that in itself is a bearish technical event. I covered that on Friday. Everybody that bought those post earnings, the big earnings beats, they've been wiped out, and by quite a bit now. And again, you can see the inflection points, and that's the thing. The market can only get so overbought, so overextended, especially with all the deteriorating technicals that we've had that I've highlighted recently, breadth deterioration and other things like that. Also some some things rolling, some fundamental indicators rolling over. But there it is. So either way, just another perfect example of another perfect inflection point, I should say. You don't always get them, but you look for those after an extended rally or an extended drop. A lot of these came near the lows as well. So that's that. So far so good. Let's move on to the charts of the markets here. Okay, we'll get to the daily charts in just a second, but again, let's not lose sight of the bigger picture, because this is where my focus has been really for months now, throughout, back here in the fourth quarter and alongside this rally. The weekly charts just continue to firm up. The bearish case, there's still some work to be done. And when I'm talking about the bearish case, my bearish case, not a correction or pullback. Again, work to be done, but what I'm referring to are the divergences now. We had divergence in place at the 2018 highs, late 2018 highs before that big drop there. And those divergences not only were not negated, meaning they weren't taken out by the indicators making higher highs, they've only extended, and that paves the way for a much larger correction, because the magnitude of these divergences now are much larger than they were back then. And so far we have almost basically a perfect breakdown of that's the entire bull market trend line. It goes to the left of the chart here all the way back to March '09, this trend line. Breakdown and a back test, and the fact that you're getting the impulsive selling, that's what you want to see. Sometimes when a stock or an index breaks down, you get a back test, and sometimes you don't. For example, let's just jump over to XLK. Here's an example of a sector, and just as leading up to these highs here, just as back then I said when tech breaks, the market will break. That's when tech broke. That's when the market broke. And again, it happened. But my point here is no back test. So sometimes you get a back test, sometimes you don't. And whether it's the market or a sector or an individual stock. And so, the two objective times to short are the breakdown itself and or the back test. And so far, so good. And yeah, you can see XLK is just, and again, this is what I talked about last week. And so we all know, okay, a correction was due. I think even if you were bullish or are bullish looking for new highs, I think you would say, okay, it'd be nice to have a healthy pullback. If you've been trading or investing for a long time, if you're new to this, a straight up advance with very few, if any, pullbacks with extreme overbought conditions is not a healthy, sustainable advance. The longer that happens, think Bitcoin, a year ago heading into the top. Think of the dot-com bubble back in 2000. So when you get these near parabolic advances with extreme overbought, extreme bullish sentiment, you tend to fall a lot harder. You don't have just the controlled corrections that you might in a normal uptrending market. So again, the advance off the December lows was unhealthy, especially when it got to this point. And let's look at the SPY and QQQ. Okay, so the story of SPY as well as QQQ, the Nasdaq 100, is one of a double top, at least in SPY, and a failed breakout. But although the breakout was marginal, very marginal on SPY, so effectively that's a double top there. The Nasdaq 100 did break out and had a sustained clear breakout, traded above there for a while. We'll get to that in a second. But that breakout's clearly been faded. So pretty bearish price action so far. And again, it doesn't mean that the market can't go on to new highs. It doesn't mean it can't come on, make it a triple top. But the impulsive nature of the selling at this point now is what I've been looking for to try to gauge whether this is or will prove to be just a healthy correction for a long overdue correction and a great buying opportunity for to position for a run up to new highs and beyond, or if it fits in and helps strengthen the case that I've been making that this is most likely just a bear market rally in a bear market that started back here when the market topped, and we effectively tested those highs, but we really haven't gone anywhere, and now we're well below that level. So right now, what I've seen recently, the impulsive selling on XLK, QQQ, SPY, and most importantly, those market-leading FANG stocks, smashing through a lot of resistance or support levels where the buyers, quote unquote, should have been stepping in. And again, today we hit some levels I'll get to in a second that they should have stepped in and they didn't. So far so good for at least what I'm trying to say is, unless anything changes this week, and that's certainly possible, I'm still looking for more downside. I'm still viewing this most likely as just an initial leg down. Nothing goes straight down forever. Even if we have an ABC correction, most corrections are at least a three-wave ABC. This is most likely the first leg down and at least an ABC corrective wave, or a three-wave corrective wave, and quite possibly more. Now let's look at levels. Let's come here. All right, a big level here is this 281-ish level, and we did close right about on it. 280, you can see 280.86. That's the closing price on SPY. That was the level, if you recall, and if you remember the site, yes, this is mostly a recap to the video I did midday, although I covered gold, crude oil, treasury bonds, and the US dollar in there. But big level here for a back test, and so this is where the bulls, they could have stepped in, should have stepped in, and now we can pick up tomorrow and rally off there. We effectively closed on that level right now. But if you recall, that was a very important level with those three failures back in that Q4 rally. We tested it for many weeks here. We shot above it, but couldn't close above it on a weekly closing basis to right here. So that was a gap up, a clear breakout. But now all that has been faded. So that also is pretty bearish. We faded that. However, here's support. And as I've said, I've color-coded these. This is still my minimum target. It has been for a long time since back here. So I still think we'll step down to that. And that minimum target is really to the level where I would view what's going on, as a healthy correction, with the possibility of the market going on to new highs. But if and as we break below there, we start getting to these, warning zones. I color-coded these with, level of importance, obviously. 260, 281-ish goes with conviction. That's a warning sign. If 280, 258 goes, that's even worse. And we should have a little time, but remember, things can happen very fast in the stock market. This is why I do these videos, and hopefully, whether you agree with my analysis or not, you might pick up some levels if you're bullish where you want to go long, but also to have your ducks in a row. Even if you're not a full-time trader, if you're just an investor, 401k, trying to manage your money, You need to have a game plan and not react to the market. Start to get in that waterfall sell-off mode. You need to know when to start, taking money out of longs, start to, putting things into cash, treasury bonds, gold, other assets. Or if you're, willing to short, there's, I think, a lot of profit to be made. There has been certainly in the last week or so here. So those are the levels I'm watching. Let's start out again with that 281. 281-ish, we'll call it. We kind of dance through it, so it's not a hard line. Below that, you can see 277.50-ish, and then on the 60-minute chart, I might add some levels, but I don't see a whole lot. If these levels go, we're probably coming down here to my minimum target. And again, the zigs and zags can be sometimes pretty easy to call, other times not so easy. So it probably won't be a straight line down, let's talk about, let's go to QQQ, and then I want to go to the 60-minute charts, cover a couple things. All right, QQQ, the video I did today, I said I'd expect today's today's sell-off to be capped at and probably get a rally off there. So I'm leaning towards a bounce, but I need to put a big asterisk on that and a caveat, and that is the fact that we are at a point now where the market could break, for lack of a better word. By break, I mean just the floodgates open. This is, we saw the market break back here. Everything that I talked about back here in Q4, before it even happened, how hedge funds were way too overexposed, in my opinion, to equity, especially in the late cycle. They weren't hedged up properly, and everybody was bullish and long the same FANG stocks. And so what happens is that you get an overcrowded trade, and it's not about fundamentals again at that point, because when everybody is bullish, Apple, for example, and the last bull has bought their last share, and I'm metaphorically speaking here, there's no one left to buy. And then more importantly, because of the indexing that we've had in recent years, that huge trend towards index investing, S&P 500 index funds, you have just a tremendous amount of money concentrated into those market-leading FANG stocks, and the more money that goes into those index funds, they grow in value more, regardless of their fundamentals. So that's what's been happening. People have been adding money because the market's been going up. So these companies become over-owned and overvalued. Whether you want to argue about whether they're overvalued or not, we won't even go there. Let's just say over-owned. And then what happens when the trade turns? There's a crowded rush for the exits, and people want out. Everyone's selling their sell orders. You go to your 401k at Schwab right now and clear today, and you click, take a couple 100,000 out of my S&P index fund. That order goes in, and they have to meet that order in cash. They have to liquidate. They have T+3, just like you or I if you buy a stock, trade day +3 to pay out the cash. And to do so, they're going to have to sell what they own. And so that's what causes these things. So again, you get these dangerously overbought conditions, and coupled with bearish technicals, like I said. Divergences, breadth deterioration, clear trendline breaks, and then in QQQ there's that failed breakout. We broke out, clearly took out this double top high from 2018, failed it. That's pretty darn bearish. And now at this point, this is where I'm saying we're getting to the point where it's not just, as I talked about before, it's normal to break out and then come in and not make a perfect back test, but sometimes undercut. But we've done more than that. This is a pretty sharp slide so far. But where we're at now, it's not over. Anything's possible. Earlier today, in the video and on the site, I said these are the levels I expect to hold, at least for a bounce. But, I'm not putting very high odds on that. I'm certainly not. I didn't close out the QQQ short trade. We came very close to our third and final target on that trade. I may even extend it. Same thing with the semis, the second target I added today. So I still believe there's more downside, whether we bounce here or not. And the thing is, if we go much lower, you can see some cascading selling, and that will be from forced margin calls, redemptions from hedge funds, mutual funds, things that we saw here. So I just kind of throw that out there that I'm leaning towards a bounce tomorrow, but I don't think it's a very, the thing is, if that doesn't happen and we cut support, we can quickly rush on down to the next level. That's what I'm trying to say. So it's not worth it. It's not, I don't think the risk reward is attractive for stepping in long, if that makes sense to you. I'm just trying to not tell you my thoughts here without doublespeak. That we should bounce here. That's where the bulls should step in. There's been a nice correction off the highs. I can't imagine for the life of me anybody that was bullish wanting to buy here why they wouldn't be even more bullish now, being able to buy QQQ 7% cheaper, and a lot of those market leading stocks 7% cheaper than they were just a couple weeks ago. And then the other thing that I mentioned in the video earlier today, and this is why on the, if you're a member of the site, especially if you're new to the site, you're like, hey, where are all the, trade ideas? I haven't seen a long trade idea in weeks. I refuse to put out trade ideas. I put a lot of unofficial trade ideas, but official trade ideas, the ones I have the utmost confidence in, I haven't been able to find any, equity-related long trade ideas because the risk reward was extremely poor up here, and I was saying that for the last few weeks. And here's an example. So now in just, what is this? Let's just grab right here. I'm going to measure out time. Grab the top of that candle. Let me move that trend line there. So right now in 10 days, just 10 days, we've dropped and wiped out the last, here, let's turn those lines off for you. In QQQ, we've wiped out all the gains for the last 2 months. And same thing in SPY. 2 months of gains wiped out in less than 2 weeks. This is what I'm talking about. The stocks fall faster than they rise, and this is why even back here saying the risk reward wasn't attractive, it wasn't, because we went up 7%, but we've lost it all in short notice, and that's what tends to happen when the technicals are clearly indicating that something like this might happen. Okay, so these are some ballpark. We have an official trade on QQQ, so I won't get specific on the price targets, but you can see some resistance levels here. I'm sorry, support levels, and that could come into play. And I could certainly add another one right here, that's about 175.70 or so. But these are the color-coded levels. And again, if we break the red line, that's where I expect waterfall type selling is where I'm sure the majority of market participants, even those that are that are still bearish and still talking about a test of the lows, they're probably talking about a test of the 2018 lows, where my guess, at least as of now, if we take that red line out, I've got it turned down here, it's about 150, 250, that we'll just probably go right on past there and keep going from that point. Okay, other than that, what I see, well, we're almost oversold. RSI is down to 31.4. But the thing about oversold is it can become more oversold. And keep in mind too, this is not bull market action right here. In a bull market, oversold readings are very rare, and they're usually one and done. When you hit oversold, you can go back on a long-term chart. Let's look at a weekly chart. Oh, well, of course, no, never mind. The weekly chart's not going to show you the daily oversold readings that we were just on a daily chart. But what the weekly chart does show you, again, is these divergences that have continued to build. We had a divergent high there on QQQ. And here's that trend line off the lows. Just these are weekly candles, and today's only Monday. So a lot can happen. I'll say that by the end of the week. I don't see it happening, but, if they could put a green candle to engulf last week's candle, well, I'll tell you, it's not going to do a lot. It wouldn't even change my outlook because it would still be below trend. We broke this trend line. It would certainly put a damper in the bearish case if they could do that, a big green candle like that, and that's how it would have to look now. But again, this just doesn't look good from a weekly point of view, weekly chart. PPOs rolling, turning down quickly, poised to make a bearish cross to confirm the divergence. RSI rolling off overbought levels, and this is more typical of bear market action. Bull market, you tend to go well over the 70 level when you get overbought, and that's the nature of divergence, is making lower highs. And right now we kissed that 70 level and rolled over quick. So like I said, not looking good unless you're short or bearish, and if anything changes, I'll let you know. Let's look at a couple more things and wrap this up. Okay, so what happened today, and put the news aside, as I always said, the news will either follow or coincide with the charts, the technicals. They go hand in hand. During a strong bull trend, good news is good news and bad news is good news. It's just shrugged off. During a bear trend, bad news is bad news, and good news good news is bad news as well. Market's gonna go where it wants to go, is what I'm trying to say. So, oh, and by the way, as far as the trade wars go, nothing new. This has been going on a long time, and it's just been a cycle of back and forth, positive news on the trade wars, negative news. This is, yes, recently we've had some negative news, no doubt, no doubt that that's triggered the breakdowns and played into, the markets going down. But again, we've gone back and forth, and at some point soon, I'm sure the White House will tweet out, Trump will tweet out something, oh, trade talks are going well, to try to pump the market up. That's just been the cycle of things. But right now, the market is taking bad news on face value because the technicals are playing out. Now, what I wanted to say is these are the things that, again, that I look at and factor in as to whether or not this is just a correction and a buying opportunity or the start of something much bigger. So if you look at this 60-minute chart here, if you recall last week, I gave bounce targets. These are 3 different resistance levels, and I didn't know which one we'd hit, but that was my uppermost bounce target if things were pretty healthy. Still expecting more downside, and my minimum target. The fact that we only hit the minimum target, remember we had that reversal and rally on Friday, and I mentioned, adding back shorts there that I'd covered and went long reverse, because we gap down. Nothing's more impulsive than a gap down. And the fact that the market had such a violent rejection off such a minor rally, that's the biggest kickback rally that we had since this correction started, and it got sold into that early at least at my shallowest, earliest bounce target. To me, that's very bearish. That's telling me there's something wrong under the hood right now in the market. So I wanted to point that out, that both QQQ and SPY failed at the minimum bounce targets and had a very impulsive rejection. So that's also a knife through the heart of longs and bulls that bought that dip, got all excited on Friday. Especially gaps, just what it does, and this is the thing about the stock market. It does the same on the bullish side when things are bullish, like off the lows on the 24th of December. The market does its best. When it makes these major turns, a major bottom or major top, when it makes a major bottom, it does its best to leave out the wannabe longs, those that want to get in, they're waiting for a buying up, and let the shorts out that stayed too late to the party. Likewise, when the market tops, it does this, again, it's not like it's intentionally doing it, it's just how this tends to work, is it'll trap longs in. So my guess is those longs that weren't already shaken out here were getting scared, nervous. They saw that late reversal. Probably said, okay, well, I'll hold on. Things are looking good. We're bouncing now. Maybe the correction's over. Or maybe they bought the dip, and then they get smoked in an overnight gap down. So this is very bearish from a psychological point of view is what I'm trying to say. All those that bought or held on thinking the worst was over, now they're, and please, I don't mean to sound insensitive if you're listening to this video and you're right now very concerned about your portfolio or your long positions, but that's the way I see and I view the market. So therefore, like I said, it just strengthens the case that I believe that there's going to be more downside here. There's a lot of people trapped in into this top here recently that we had, and most importantly, I don't see much right now from the charts to make me go long. You can see some support down here, 176.74. We might catch support there. So maybe we'll gap down tomorrow, pop up. But again, if we keep going down, that's what I'm trying to say. It'll tell the nature of this, of what's going on in the market. So if we keep slicing through support levels that should catch a bounce, that buyers should step in, and we slice through them like they're not even there, or we have a little minor reaction, start to rally, and then that gets sold into. Again, that plays into the bigger picture for me, which says this was a bear market rally, and if it was, you would expect this next leg down to start with a bang. And so far it has, but like I said, we start getting down here, we keep slicing through, that'll further reinforce the case. But if we can rally now and start to shape up the 60-minute charts and everything else, there's still a chance that this market could hold support and ultimately go on to new highs from here. So like I said, we'll watch. I always say the charts are dynamic, and so is my analysis. So that was QQQ. I showed you the bounce targets. Let's just look at SPY on the 60 minutes. These were the bounce targets from last week. There it was. I had these two yellow lines, 288, 30, 83. 288, 83 was my minimum target, almost to the button. So A, that was just a golden shorting op, and B, more importantly, it shows the nature of this market with that impulsive move down and a failure. That's all the market could do. That's all the buyers would, that's it for the buyers that stepped in to buy the dip. And so it shows me that there's, other things going on, and whether it's forced selling by institutions, and undoubtedly there's probably some margin calls going on today, and that's where, and I'll leave the video here. That's where the tough part is. I talk about very often the rubber band in the markets. This is a rubber band. You can stretch a rubber band, and the farther you stretch it, the harder it's going to snap back when you let go. The stock market's like that with corrections and with rallies to the upside. So the rubber band was stretched very high to the upside, and so therefore it's snapping back pretty hard to the downside now. However, if you pull a rubber band far enough, it breaks, and that can happen in the market, and that's where you have crashes, market crashes. I'm not trying to be dramatic. I'm not saying we can't have 1987 again. We cannot. It's physically impossible because of circuit breakers that were put in place since then. But we can most certainly have very impulsive selling here. So if the same factors that went into play here, and again, I'd be surprised if they didn't happen, where you get the unwinding of margin call. We had a huge margin bubble at this point. I put up charts showing how high record high margin interest, and that's the same thing that happened back in 2007 at the market top. And so what happened? Also the fact that in my opinion, hedge funds, which are already underfunded, are too heavy in equities. They're too bullish on their outlook. They're going forward. I'm talking about pension funds. I mean, like CalPERS, for example. And if the market continues to go down, they're going to have to take proactive measures to curtail their risk. They're already underfunded, and they can't afford to sit through another 20-25% drop in the market, because it's certainly possible. And I think even though I don't agree with their projected returns and their current asset allocation mix, I'm sorry to pick on CalPERS, but that's the biggest one. I think they're smart people running that, and they'll start to reduce their equity holdings, and it's just a cascading event if it happens. So there it is, guys. I hate to sound doom and gloomish. Like I said, there's plenty of support levels and plenty of time for the market to catch support. I just don't see a lot right now in the charts today that say, if you are short and you've been short and you just want to swing this down, or if you've moved out of equities in your 401k and you want to get back in. I had a couple people on the site ask today, hey Randy, I'm looking for another like December 24th type thing for to get back long into 401k. I don't think it's anywhere close yet. It could be close in time, but not in price. So if when that comes, and maybe we'll be able to nail the bottom. Maybe we'll have to pound out a bottom first. I'll share my thoughts, and of course I may be wrong, but as of now, that's the way I see it. I don't see this market can go either way tomorrow. It could bounce, it could go down. I don't have a strong opinion on where we go tomorrow, but I think in the coming days to weeks, there's more downside. And any bounces to the upside, well, let's just go back to those same levels I gave you yesterday on Friday, and they were already hit. So I don't think they're going to be hit again. That's the thing. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.